One of the most popular dividend king stocks out there is PepsiCo, stock ticker PEP, currently trading at $166.52 per share. And over the past year, while the market is up quite a bit, they're down 9.9% and year to date down around 7.18%. Now, earlier this year, they actually traded as high as around $196 per share, but their 52-week low around $155, which they hit just a few weeks ago. Now, if we dig into the dividend metrics for this company, we can see at this current price, they have a starting dividend yield sitting at 3.03%. And if we look at that dividend yield 4-year average history, that's 2.72%. So their starting dividend yield a little bit above that 4-year average, which is something that I like to see. Now, when we look at the dividend history for this company, again, 50 consecutive years of dividend increases. That's obviously phenomenal, something we love to see as a dividend investor. And if we look at these dividend growth rates, we can see in 2013, they were paying out 54 cents per share every single quarter, and jump forward to now, it's now sitting at $1.27. So really nice dividend growth. And if we look at those dividend growth rates, I'll scroll down, we can see the 3 and the 5-year dividend growth rates, both sitting at around 6.8 to 6.9%, pretty solid, and the 10-year dividend growth rate sitting at 8.13%. So that is pretty decent dividend growth, but when you consider the fact they've been increasing dividends for 50 consecutive years, I think that is pretty phenomenal. Now, obviously, all this means nothing if those dividend payments are not safe, so we need to look at the dividend safety. Now, the first thing when we glance at this is that dividend payout ratio for the trailing 12 months non-GAAP sitting at around 64.31 and forward-looking 65.39, but really my favorite payout ratio to look at is the cash flow payout ratio. That's because dividends are paid out of free cash flow, and this tells us exactly how much free cash flow is being used to pay out dividends, and in this case, it's sitting at around 53%. Now, keep in mind with free cash flow, there's a few different things you can do. You can do things like pay down debt, pay out dividends, reinvest back into the business, buy back shares, or attempt mergers and acquisitions. So if 53% of the free cash flow is being used to pay down dividends, just keep in mind that only leaves 47% to do the other things that I just mentioned. Now, I think for a dividend king, that's actually a very healthy range, so I'm really not concerned. I think that's a pretty good place for PepsiCo to be overall. Now, to dig into this company a little bit more, one of the things I want to do is dig into one of their annual reports and go over a few different things. Now, when people think of PepsiCo and think of competitors, the first thing they think of is Coca-Cola. And yes, Coca-Cola is a massive company with a ton of different brands, but one of the things you'll notice about Coca-Cola, when we look at these brands, all of them are beverages. And this is a huge advantage for PepsiCo because a large portion of their revenue actually comes from food. We can see 58% of their revenue comes from food, while 42% of it comes from beverages. So yes, both of these companies are large and have strengths and different weaknesses, but it is important to keep in mind that PepsiCo is different in the sense that a large portion of their revenue comes from food. Now, if you really want to dig deep into a company, one of the things you can do is dig into their Form 10K. If you read a company's 10K, you will know more about that company than 99% of most investors. And 10Ks are pretty phenomenal. It pretty much lays out exactly anything you could want to know about the business. They'll even tell you some of the risk factors, which is actually one of my favorite things to look at for a business. So we're going to go ahead and glance at a couple of different things. If we jump to the 29th page, one of the things that we'll notice is our business can be adversely affected if we are unable to grow in developing and emerging markets. Now, I think this is an important factor we need to consider for PepsiCo. Obviously, they already have a large market share, so if they are going to see decent growth, we need to be turning to those emerging markets. So if you're interested in PepsiCo, that's definitely something you want to keep a lookout for. And if we scroll down a little bit further, another major factor that could really adversely impact the business is the risk of economic conditions. PepsiCo, while they do have a lot of strengths, is not a company I would consider recession resistant. Obviously, things like high inflation, interest rates, tax laws, and tax rates could play a large role in the future of this company. The last thing I wanted to glance out on this 10K was simply the consolidated statement of income. And we can see we have 2022, 2021, and 2020 listed. And for a company that's been around as long as Pepsi, they've actually seen pretty good growth in revenue and net income over the past few years. We can see here where they were at in 2020 and where they were at in 2022, and most of those gains were able to find their way to the bottom line, as we can see right here when we look at net income. So the question that I want to answer now is PepsiCo trading at $166.52 a good price to consider buying in at? And to answer that question, we'll be jumping into my stock valuation spreadsheet and looking at a few different valuation models. And like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in the stock ticker PEP and hit enter, and you can see all of this data will automatically load in. We're looking at a 365-day change chart, so they are trading closer to that 52-week low. We can see the 20-day moving average up slightly, but the 50 and 200-day moving average down a decent bit. Analysts have a target price of around $187, institutional ownership close to 75%. And here's what's interesting, a beta of just 0.57. So if you're someone looking for very low levels of volatility with your investments, this is a good company to consider. Now, the first valuation we typically look at is Graham's valuation, but I really don't like this valuation for large dividend king stocks a lot of the time, such as PepsiCo, because I don't think it provides a fair valuation. So we're going to actually move forward and start with our discounted cash flow analysis. And I'll go ahead and zoom in, but basically what we need to do is project a growth rate for the future free cash flows of this company, and that will help us get an intrinsic value. So what I've done is I plugged in historical free cash flows, analyst projections, industry projections as well, and I decided on a growth rate of around 8.25% for the future free cash flows of this company. I found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, subtracted out the total debt to get equity value, divided by shares outstanding, and came to a DCF price per share of around $104.35, quite a bit below that current trading price actually. Now, the next valuation we'll look at is the multiples valuation. And the two companies we're going to look at in this scenario are Coca-Cola and Monster. These are really the only good comparables for Pepsi. And one of the things you'll notice is most of these companies trade at a fairly high price to earnings multiple. The market seems to really like buying these companies at a premium, which really isn't a surprise when you look at the history of these companies. So the average price to earnings for these companies sitting at around 30, and when you multiply that by Pepsi's earnings per share, we come to an intrinsic value of $180.26. Now the last valuation we'll look at is the dividend discount model. Basically what we're doing is we're valuing the company based on how much they pay out in dividends and how much that dividend will increase over time. So I plugged in the quarterly dividend payments over the past few years so we can see those yearly dividend payments and the dividend growth rates every single year. We have 7%, 5%, 7%, and the most recent, a really solid one at around 10%. That's an average growth rate of around 7.3%. Moving forward, I think a dividend growth rate for them of around 5.5% should be pretty sustainable for quite some time. And with a discount rate of 8%, that gives them a dividend discount model price per share of $213.53. So when we jump over to the output tab, we can see the three valuations that we used: multiples at 180, DCF at 104, and dividend discount model at around 213. That actually gives us an intrinsic value that is right at their current trading price. Now, these valuations are a little bit all over the place, as we can see. DCF comes in pretty low, dividend discount model pretty high, and the multiples pretty close to its current trading price. But again, average those out, and we're right at the current price. So with a 10% margin of safety, it looks like your acceptable buy price sitting at around $149.44, and with a 20% margin of safety, acceptable buy price of around $132.84. Now, PepsiCo isn't a company that I personally own in my dividend portfolio. If I were to consider it, I'd like to see it come down quite a bit lower, because really a starting dividend yield of 3%, that is pretty solid, but I think there are opportunities to find companies with higher dividend growth rates out in the market right now, which aligns pretty closely with what I'm looking for. But there you go. There is a quick analysis on PepsiCo. Go ahead and let me know what you think of this company in the comments down below. If you'd like to be able to join a community of dividend investors and get access to all of my spreadsheets, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.